Hi, welcome to today's video, which as you can see will be on the balance sheet. Balance sheet is a photograph of the business at a point in time, and the photograph is going to look at two things. What we got in the business, which are commonly called assets, and how we got that, borrowings from others, or our own investment in the business, which we call owner's equity. So let's look at what we got, the asset side of the balance sheet. Quick note, what's in black is what you will be doing on the balance sheet. What is in blue and green is just side notes only for your own benefit. So, assets, what we got. Is there an order to the assets? Yes. That order is liquidity, and we will see that in later modules. Right now, what I want you to concentrate on is just getting assets in the asset section and not in liabilities, equity, revenue, or expense. Just try and get things where they belong. But in a couple modules, I do expect them in proper order. So, assets. Cash generally goes first. It's in order liquidity. Of course, the most liquid asset is cash, and so that always goes first. Accounts receivable goes second. Now, what is an accounts receivable? That's a customer who came into your store and charged something on account, and so you will be getting money from him at a future date. And so it is a receivable to you. Money will come to you at a future date. Then after that, we have inventory, office supplies, and prepaid insurance. These are commonly called current assets. What a current asset is an asset that will change into cash within a year. So again, a current asset is an asset that will be converted into cash within a year. We also have fixed assets, land, buildings, and equipment, commonly in that order. Now, a fixed asset is an asset that's fixed with regards to the business. You're not likely to sell them because if you did, your business might cease to exist. For example, a pizza delivery company is not going to sell its automobiles because if it did, then it would have no way of delivering the pizzas. Hence, it may not even be in business. Liabilities. Yes, they will be broken into current and long-term. We're going to, at first, look at only current liabilities, but eventually we will be looking at the long-term ones as well. Generally, they're in this order, with accounts payable going first. What is an accounts payable? It's exactly the opposite, basically, of an accounts receivable. So you go into, say, an office supply company, you buy some paper and pencils, and you charge it. So that is an accounts payable to that office supply company. So you owe to another business. So again, accounts payable is a business-to-business type payable. So you owe to another business. Sometimes you can't pay or the vendor wants you to sign an IOU. That is a notes payable. So an IOU is a notes payable. And we'll often have other liabilities as well, example, taxes payable. Adding them all up, we get total liabilities, in this case of $3,000. Now, for a corporation, the initial investment in the business and subsequent investments is usually evidenced by common stock that has been issued. Now, notice we indented that. That's in the subtotal column. And then retained earnings. That's earnings that have been retained in the business over time. Again, we get that from the statement of retained earnings. And so that's the owner's investment that in terms of net income that he's made over time and that he has not received back in the form of a dividend. So that adds up to $37,000. Total liabilities and owner's equity is $40,000. So what we got, $40,000 in assets at June 30th, 2014, in other words, a picture of the business, at June 30th, 2014, equals to how I got it. I borrowed some money, in this case $3,000, and I invested some money, $37,000, in the business over time. So let's rehash the balance sheet. name of the company, name of the statement, and the time period, or point in time in this case. Assets. Those are what we got. Yes, they are in order: cash, accounts receivable, inventory, office supplies, and prepaid insurance, which are current assets. Land, buildings, and equipment, which are fixed. Total assets, $40,000. Again, current assets are those that will turn into cash within a year. Fixed assets are those that are more or less of a permanent nature for the business. Selling those would perhaps endanger the company's right to be able to do whatever it does in the future. Liabilities, accounts payable will be listed first. Notes and taxes payable gives us total liabilities. Owner's equity, common stock, and retained earnings. The two added up gives us $37,000. Liabilities and owner's equity are $40,000. In accounting, we never assume anything. Always double check that what we got equals to how I got it. If it does, then our balance sheet theoretically should be correct. A couple notes. Where could I make mistakes on a balance sheet? Well, one of the biggest ones is to put receivables on the income statement as a revenue, or payables on the income statement as expense. Receivable, again, is money that I will receive in the future. It is an asset. A payable is an amount of money that has to be dispersed in the future. It is a liability. The second most common error is to put revenues over here as an asset and expenses as a liability. So be careful not to do that. So again, a balance sheet, a picture of the business at a point in time. This picture shows that this company is pretty well funded. Its liabilities are 3 out of total liabilities and equity of 40. If, on the other hand, the liabilities had been 30,000 and the equity had been 10, that company would have been underfunded. In other words, it would have had, the creditors would have been the owners of the business. It would have a hard time getting a loan at the bank. So very important to look at all these things when analyzing the balance sheet. So I look forward to seeing you on the next video. Take care and have a good day.